Kenneth Andrade, founder and CIO of Old Bridge Mutual Fund, joining us this morning on Talking Point. Kenneth, great to speak with you, and great to have this conversation in the first full working year of 2026, just to set the pace of what we can expect. I mean, we've started with, I would say, a lot to chew upon with what's happened geopolitically in this Venezuelan heist, as I like to call it, and how global markets have responded to it as well. What do you think is going to be the outlook for the year? First, let's start from a geopolitical point of view. More of the same with what we saw in 2025, a lot of uncertainty?
Well, that's really not my domain. So I assume that what's happened in the last 1 year and what's happened at the beginning of this year will more or less be in continuation for the rest of 2026 or probably longer. So it's going to be an uncertain environment as far as that is concerned, and we just have to play it by ear and see which side of the fence we as an economy come out on. So no predictions out there. Expect more of the same and cross your fingers and hope nothing dramatic happens.
Believe me, Kenneth, even those who are in the business of predicting what's happening geopolitically right now are choosing not to do so. My question more in the aspect of how do you prepare as an investor? One thing that we've seen, at least in the last few months, is Indian equities shrugging off some of those concerns and focusing on what companies are doing and how they're performing. Is there optimism going into Q3 and Q4?
So let's put it in perspective, right? India is coming out of a phenomenal run between 2020 to 2024, right? 2025 was slightly sluggish, and 2026 you see more of the same. So it's not like the Indian markets are not doing well. We're just taking a small break out there. We were the most expensive market amongst our peers, and I think the rest of the world is catching up with us. I think that's what's happening out here. So we're taking a breather. It's a time correction. Everything else remains static. Balance sheets are good. Demand is plodding along. We're not excessive, or we're not falling off the cliff. The government's doing its bit. Trade wars are uncertain, or the trade cycle is uncertain. So we're dealing with uncertainty out there. There's no predictability, and you had high valuations. So those valuations are having a time correction. That's all that there is to it all. Maybe 7 months of incremental amount of sideways movements. It's going to be a little difficult trying to pick a trend out right now. But I think patience is largely the game out here. Single digit return still on the table, but I don't think you're going to get anything dramatic out there.
Interesting take, Kenneth. Good morning. Hiral on this side, wishing you a happy new year as well. You've been talking about a time correction until early 2026 as well, and that was your expectation since quite some time. With FI outflows actually hitting record high levels in 2025, do you believe that a return when it comes to FIs in 2026 is a necessary condition for the Indian markets to actually get a healthy double-digit market return, or will the DI inflows suffice the domestic growth story?
Well, Hira, put it together. Firstly, a very happy new year to you and the team also. Firstly, to put it together, what attracts investments into the country, whether it's DIs or whether it's FIs, right? So DIs have a constraint on the fact that they can't take money into any other asset class but the domestic market. And that's what's driving allocations into the domestic market, which is at the back end, a lot of flows coming through. FIs have no such compulsion. FIs can move to markets wherein they find safety of capital and reasonable amount of growth, but at a certain amount of valuations. I think what's happening in India is a little bit of both. You had 1 year of time correction. You're going through the second year of some part of that will be time correction, and then valuations will start becoming attractive. Look, net, the breadth of the market has completely collapsed. There are more losers than there are gainers this year. While the index has been where it is, the product markets are not that great. And the IPO markets or the new issue markets that are there, that's taking a drain of liquidity out from the system itself. So put it all together, once you get valuations within the framework that is acceptable by most international investors, they will come back into the economy, or they will come back into the market. Every investor likes to see growth, but every investor is not going to pay upfront for it. The investors who are paying upfront for growth on the market in the market today are the ones that have got surplus liquidity. So I think that's the dilemma that we are in right now. Another 1 year of what we saw in 2025 to 2026, and by the way, 2025 wasn't as bad. You're getting a low double-digit return, which I don't think is terrible. And if you get another 1 year like this, and valuation should be more or less palatable for by the end of the current calendar year.
Okay. So, Kenneth, the valuations are going to be palatable at the end of the current calendar year. Which sectors are you eyeing? Because all eyes from a couple of fund managers that we've been discussing is that 2026 is going to be a year for Indian IT. Do you think we could benefit from the AI advancements? And if so, which specific segments are you looking at from the Indian IT space?
So look for underperformance of companies, businesses, sectors over the last year and a half to maybe three, or maybe a cycle. Look for industries where there is a reasonable amount of pressure of margins that are there and do not have the pricing power at this point in time. And then you just have to wait, build a portfolio around that, and wait and have some patience till the cycle reverses itself. I think that's been our style, and that's how we've been adapting to it. So IT has been there. It hasn't done anything. It's come back to valuations which are great, but it's not really a growth business out there. It's a nice place to be in. It's a good allocation trade. I could say the same thing about the financials of the lending business out there. At least the big banks are in a zone wherein, again, valuations are okay. There's some element of growth that is coming through, and the risk on the downside doesn't seem that doesn't seem too high. Then there's pharmaceuticals, especially the manufacturer-driven pharmaceuticals. Nothing has happened out there for a long period of time. So another place where I think will attract a reasonable amount of allocation during this year. So you got to go out there and pick and choose industries that have not done anything. Look for valuations which are okay. Uh, the first thing is that you do not lose capital in that cycle, and then incrementally you look at growth. I think the momentum out there today is basically discretionary spends, more specifically in the automotive side of the business. Um, uh, I mean, that still, my sense is that still has a little bit of legs, at least for 2026. Valuations have come up quite sharply because a lot of these companies are up high double digit in terms of percentages over the last 1 year. Telecom is pretty much okay, driven by cash flows. It's got the momentum behind it. You've seen price increases and profitability and cash flow growth that's there. So it's not a place where you can't find ideation, but yes, you'll have to make sure that you contain your expectations going into this 1 year.
Containing the expectations, yes. I'm just wondering if there are any possible upsides, especially in the BFSI space, Kenneth, from the initial readings that we're seeing in Q3. BFSI and FMCG or consumption baskets seem to be in focus, spillover of all of the policy action from last year. Are you feeling optimistic about some of these sections?
So the last part of that blip is already in prices.
Okay.
The trade that you saw that happened in the last quarter is largely around what policy actions that the government's taken or the local government's taken. So a lot of that is already in prices. I think they will just follow the momentum of the news flow currently. But if you're looking at big compounders in this entire industry, you'll get one or two names out there, but it's largely stock picking. I can't see an entire category of businesses that are growing dramatically ahead of themselves, a category of businesses. So basically, the whole consumption basket is not going to grow significantly, or profit pools in the consumption side of the business is not going to grow dramatically. Same thing holds true for banking. So it's largely a pick and choose market. Again, at the beginning of this conversation, I said you'll have to pick and choose in this marketplace. It's very hard to find a trend. It was consumption the last quarter. this quarter, our sense is that you will have government spending come to the forefront, but that will have its own pitfalls that are there. So you just have to wait till valuations across the spectrum actually stabilize, and with the market formatting it itself the way it is, which is the advanced declines against you, I think you will get a valuation spectrum which is far more attractive somewhere in the middle of the year.
What are the key sort of, and you've put it well, Kenneth, that there's no trend per se to pick. You're going to have to do some work for stock picking. And so for our viewers who are tuning in and wondering how they go about it, or some of the filters that you apply, what would you tell them?
So it's anything that hasn't done well over the last couple of years. Okay, may not be the last 1 or 2 years, but on a longer time format. I think any industry, business, company that has been struggling with a bad cycle, and using some of these companies in a fairly decent valuation matrix. Okay, there are quite a few out there. So without naming names, I've put together some industries that haven't done well over the course of the last couple of years. So that's where you start looking at, and then it's a patience game.
Kenneth, my last question coming to you is, you have been looking at a strategic focus when it comes to a Capex-led growth for 2026, right? With the kind of upcycle that's already come in when it comes to the metal space, how are you looking at it, and your view when it comes to pharmaceuticals and automobiles?
So we've been constructive on metals for a couple of quarters, if not a couple of years, right? And like I said, investing is all about buying when no one's talking about it, and then riding the cycle on the upside. And I think that's all started playing off. For us, it was not so much commodity prices. For us, it was actually volume growth for the capacities that some of these companies are putting on the ground. And the icing on the cake was if commodity prices did well. In this case, volumes are coming through and commodity prices are also up, and that's how the metal pack is done well. When it comes to pharmaceuticals, again, it's a business where there are a lot of headwinds this year with in this space, with one product actually going off patent. That's going to damage industry profitability quite significantly in the last quarter, in the last 6 months, which is essentially is December and March quarter. And that should be the bottom of this entire business. This is a category, or this is a segment of the market we think profit for the entire industry will be dramatically high compared to what they've seen in the last 5 years. So it's a space where you're buying into underperformance and then wait till profitability kicks back. There's a lot of capacity on the ground. There's a lot of opportunities as patents actually come off, and the Indian generic manufacturing capabilities will come to its forefront. So that's where we got positioned. So metals played out, pharma is out there, automotive is got a momentum cycle. IT is coming off low valuations, but it's a fairly mature business, so it's not going to be something very dramatic or dramatic, so as to say. Consumption is building up, but these are largely company-specific names out there. They've already hit rock bottom in terms of how low can the business go, how bad the business can get. Now it's consolidation time. You're seeing it with a couple of segments out there. But you really have to see demand revive and inflation come back into that segment. So consumption is on standby. Pharma is going through its down cycle and basing out this year. Commodities and automotives doing reasonably well.
All right, Kenneth. That's going to be interesting, and the metal upcycle is something that the street is watching out for. But thank you so much for joining us on the show. Always a pleasure to speak to you at NDTV Profit.